UK house prices have been falling for months, and 2026 could bring even more shocking declines. Are we heading for a market crash, or is a rebound finally on the horizon? You need to see this before making any property moves. Welcome to UK Property Authority, the channel where UK real estate meets real news. Every week we expose the market's biggest shifts, from housing prices to mortgage shocks, so you can make smarter moves. Let's get straight into today's update. House prices in the UK have experienced dramatic shifts recently. Following the post-pandemic boom, where low interest rates and pent-up demand caused property values to skyrocket, 2025 saw a sharp slowdown. The Bank of England increased interest rates to combat rising inflation, mortgage rates surged, and affordability became a serious issue for first-time buyers. Many families who hoped to move up the property ladder found themselves priced out, creating a ripple effect that slowed transactions across the board. Analysts are now warning that the effects of these changes are not over. In 2026, the market could continue to experience downward pressure, particularly in regions that saw the steepest price growth over the past decade. London and the South East, long known for their sky-high property values, are showing signs of correction, with average house prices falling in multiple boroughs. In contrast, some northern cities like Manchester and Leeds have remained relatively resilient, with only modest declines, largely due to sustained demand and ongoing regeneration projects. One of the most critical factors influencing the 2026 outlook is interest rates. Mortgages are at historically high levels compared to the post-pandemic era. While many buyers secured deals at record low rates, those entering the market now face repayments that are significantly higher. Even a small rise in mortgage rates can reduce borrowing power dramatically, pricing some buyers out entirely. Experts warn that if rates remain elevated, house prices could face further downward pressure, particularly for mid-range properties that are heavily reliant on first-time buyers and domestic demand. Affordability is also a key concern. Wage growth has struggled to keep pace with inflation, meaning that even if interest rates stabilize, buyers are still grappling with higher living costs. Essentials like energy bills, food, and transport have taken a larger portion of household budgets, leaving less room for mortgage payments. For many potential buyers, this has shifted the market dynamics from one of active bidding wars to cautious evaluation, with sales taking longer to complete and some properties sitting on the market for months. The rental market adds another layer to the picture. With property prices stagnating or falling, rental demand has surged in certain areas, particularly among younger people who cannot afford to buy. While this has provided some income stability for landlords, it also reflects a market where ownership is becoming less accessible. High rents can deter first-time buyers from saving for deposits, prolonging the period in which house prices remain under pressure. Additionally, rising interest rates impact buy-to-let investors, making new purchases riskier and potentially slowing the supply of rental properties. Government policy could also play a decisive role in 2026. Recent initiatives aimed at helping first-time buyers, such as shared ownership schemes and Help to Buy extensions, have been criticized for inflating demand in some markets without addressing underlying affordability issues. If the government introduces new incentives or reforms, it could temporarily boost buyer activity and slow price declines. Conversely, a lack of policy support could exacerbate downward trends, particularly if combined with further interest rate increases or economic uncertainty. Economic indicators suggest caution. Inflation, while slightly lower than its peak, remains a persistent concern. Uncertainty over Brexit trade deals, global economic pressures, and energy market volatility could all influence household confidence. Property is often seen as a safe investment during turbulent times, but when disposable income is squeezed, even previously confident buyers may postpone purchases, contributing to slower sales and price corrections. Another factor to consider is the imbalance between housing supply and demand. Despite falling prices in some regions, the UK still faces a chronic shortage of homes. New builds are not keeping pace with population growth, and planning restrictions continue to limit development in key areas. This mismatch could act as a stabilizing force for prices, preventing a full-scale crash even if demand softens temporarily. Experts often point out that while we may see declines, a total market collapse is unlikely because the fundamental need for housing remains strong. Regional variations will be crucial in determining how the market behaves in 2026. While London and the Southeast may continue to experience sharper corrections due to previous overvaluation and high borrowing costs, northern regions could see more stability. Scotland, Wales, and Northern Ireland have their own unique dynamics, with some areas continuing to experience modest growth while others face stagnation. Savvy buyers will need to pay close attention to local trends rather than relying solely on national averages. Investor sentiment is another element shaping the market. Property investors, both domestic and international, play a significant role in the UK housing sector. Rising rates and economic uncertainty have already cooled speculative investment, which has contributed to slowing price growth. If investors continue to pull back, particularly in high-cost urban centers, this could apply additional downward pressure on property values. On the other hand, long-term investors with confidence in regional growth may help stabilize certain markets, particularly where rental demand remains high. One of the hidden risks for 2026 is the potential for a feedback loop between falling prices and reduced confidence. When homeowners see their property values decline, they may feel less wealthy, leading to reduced spending and a slower economy. This, in turn, can impact buyer sentiment and create further downward pressure on property prices. Economists warn that if such a cycle takes hold, the market could experience a prolonged period of stagnation rather than sharp short-term corrections. Affordability pressures, high interest rates, and regional disparities are all converging to create a complex picture for 2026. While some areas may experience minor rebounds or stabilization, others could see continued declines, particularly in overheated markets that have relied heavily on debt-fueled growth. Potential buyers are advised to approach the market cautiously, consider fixed-rate mortgage options, and factor in longer-term affordability rather than assuming prices will rebound quickly. Despite the uncertainty, there are reasons for cautious optimism. The underlying demand for housing in the UK remains strong due to population growth and a continued shortage of new builds. First-time buyer schemes and government incentives, if properly targeted, could support market activity. Additionally, any stabilization in interest rates or easing of inflationary pressures could encourage more buyers back into the market. In conclusion, the UK property market in 2026 is likely to be a mixed picture. Prices may continue to fall in certain regions, particularly where affordability pressures are highest and interest rates remain elevated. Other areas, particularly in the north and mid-sized cities, may experience relative stability or even modest growth. For homeowners, buyers, and investors, the key will be staying informed, understanding local trends, and planning purchases carefully rather than relying on assumptions about national averages. Ultimately, while a total market collapse seems unlikely, the risk of continued price corrections is real, especially for those entering the market for the first time or relying on high borrowing levels. The coming year will test the resilience of the UK housing sector, and the choices made by buyers and sellers now will have long-lasting implications for personal finances and the wider economy. Thanks for watching UK Property Authority. If the video helped you, hit like and comment your thoughts below. Don't forget to subscribe and turn on notifications so you never miss a major UK property update. See you in the next one, your authority on the UK real estate market.